Well, the era of Trump 2.0 has begun, and though risks of reigniting inflation do persist, President Trump is inheriting a U.S. economy that's in pretty good shape. On his first day in office, President Trump injected some uncertainty into that backdrop, though, signing the most day one executive orders in recent history. Joining us now, we want to bring in Mohamed El-Erian. He is the president of Queens College at Cambridge University, also chief economic advisor at Allianz, also alongside market domination co-host Julie Hyman. Mohamed, it's great to have you back here on Yahoo Finance. I'd love just to get your first reaction just in terms of some of the market implications, economic implications from the executive orders that were signed yesterday.
Thanks for having me on. The market wanted to treat yesterday like drops Friday or the CPI date, which is an event risk, and you get the information and you move on. What the market is realizing is that this is much more dynamic. This will go on for a while. And you mentioned what happened in the FX market. That was fascinating because on the first set of trade-related comments, the dollar weakened quite a bit. Then we got the second set a few hours later, and the Mexican peso depreciated, the Canadian dollar depreciated, and the dollar regained half of what it had lost. So the message is this is not a one-day event risk, both upside and downside. This is something that's going to remain with us. So far, the market likes what it has been hearing, but it's early days.
Mohamed, your point is well taken. This is just the beginning of what could be a long 4 years for the markets. In the next, say, 100 days, obviously that's usually a period that people watch closely. What are you going to be watching most closely? What's going to be most pivotal for markets?
So 5 areas. Some we know already. So energy is really important. And that we've heard a very clear message from the president about drilling. Immigration is a second issue because that impacts the labor market. And to what extent are we going to see the repatriation of illegal immigrants? And how does that impact the labor market? So that's the second one. Trade, of course, and we are early days. If anybody in China or Europe is relieved, I tell them just wait. It's early days. So we need to see what happens on tariffs, deregulation, and fiscal. So 5 areas, all of which have a significant impact on earnings, on the economy, and will influence how the market behaves.
Mohamed, you recently wrote in the Financial Times about many things, among them that one of the things that propelled Donald Trump to this second term as president is sort of the economic dispersion in the United States. The idea that the economy, as we showed coming into you, is on pretty good footing, but it did not benefit everyone equally. From what we have seen from this administration in the first day and from what you're expecting, do you think that's going to change? Do you think that the measures that Donald Trump is expected to implement are going to go to the heart of that issue that got him into office?
Yeah, I mean, the issue of dispersion, or what a lot of people call the K-shaped economy, where the rich are doing better, but the poor continue to struggle, that was very well understood by President Trump. And that is the reason why the electorate didn't appreciate the economic exceptionalism that everybody talks about, that is strong U.S. growth, because the benefits of that growth were not shared widely. And if you're at the bottom of the household income distribution, you've run down your pandemic savings, you've maxed out your credit cards, and you're insecure, you're financially insecure. President Trump understood this much better than the Democrats. The Democrats were never able to address that issue in a manner that allowed them to get credit for the overall economic performance. So there's full awareness in the Trump administration of this issue. There's a promise that they will address it. And that's why the details of the fiscal are going to be so important, as will other parts of the policy. But it is fully understood by President Trump because it has helped propel him back to the White House.
And so what we've heard, Mohamed, is that there will be a golden age of America. Will that golden age of America then extend into the income cohorts that have not felt like they've been in a golden age, even if we do see an extension of the Tax Cuts and Jobs Act in a 2.0 fashion?
It must. If we are going to have a golden age, there has to be better trickle down, and I hate that word, but better trickle down to the low income people. You cannot run an economy with K-shaped characteristics for a long time. Just like at some point, we have to worry about the bad and the ugly of the global economy. You've heard me say this. The good of the global economy is the US. The bad is China. The ugly is Europe. These are the three major economic areas. And there's massive divergence as well there. The US is outpacing the other two. The IMF revised its global economic outlook for 2025. Guess what? It took the US growth rate up by 0.5 percentage points. That's an enormous amount for a large economy. And it took down Germany and France. So these two issues are going to be key. One, can he address internal diversion between the rich and the poor? And two, can he convince China and Europe to get their act together so that we don't get this external dispersion? Because either we're going to level up the global economy or we're going to level down the global economy. And leveling up is a hell of a lot better than leveling down.
Mohamed, what strategies then should investors adopt then in response to that economic divergence? And where does that leave the U.S. relative to the rest of the world?
So I think you need to embrace three things. One is volatility. This is going to be a volatile year because of all sorts of things going on. The second is dispersion. Take dispersion seriously. We're going to see it across countries. We're going to see it within countries and also within sectors. And then the third element is to understand that we've gone from an investment approach that was market-based to a second one that was theme-based. And now we're going to much more name-specific based. And that's really important because if you're simply a passive investor, you didn't gain much when we went from market-based to theme-based, but you're going to lose even more when we go from theme-based to name-specific.
So that implies then that this needs to be an age of more active management, more of a stock pickers kind of environment?
Yeah, in a perfect world, it's much more active manager, it's much more name-specific. If you can, and many cannot, you should combine public with private opportunities. In private opportunities, you can structure exposures much better. So this is going to be increasingly building portfolios from the bottom up and not just from the top down.
And what does it imply? You were just talking about how the U.S. is still on the strongest footing. There has been some increasing chatter, though, about whether investors maybe should be looking elsewhere, either to developed or emerging markets. For example, this morning in the Wall Street Journal's Heard on the Street column, they talked a lot about valuations and the gap between the U.S. and the rest of the world is at an unusually wide level, right? And maybe that creates some opportunities. Do you think that's how investors should be thinking about it also?
Julie, I'll give you the same answer I've been giving you for years. It will be at some stage, but it's not now. There's a reason why we've had this valuation gap. The US is a much more dynamic economy. Its growth is outpacing other major markets. It controls more of its destiny. It's not as vulnerable, Europe, for example, to energy issues. It's not as vulnerable to emerging markets, to currency moves. And then finally, ask yourself, who is investing in the growth drivers of tomorrow? Who is seriously taking AI, life sciences, defense, healthcare? Most of the investment in that is happening in the US. Why? Because it's led by a handful of large companies that are US companies. So when I look at all this, yes, valuation differences are large, but I suspect they'll get larger before we start having the convergence trade that people have been calling for, as you know, for years now, and it hasn't been a good call.
Mohamed, you mentioned the active management, the perhaps stock picking even of some of the winners and themes that investors should be leaning further into. But does that, and after we had seen some of the tech CEOs that had exposure in one form or another to generative AI and their companies' investments there, does that mean that there's going to be a deceleration in the type of return that we see from some of the generative AI or AI-focused companies that have had a lot of capital to deploy and investors being able to just kind of set it and forget it into those stocks?
So I think we're still looking at positive returns, but not as positive as what we've seen. There's an old phrase that a friend of mine at PIMCO used to say, you can't go to heaven twice on the same deed. So, the markets have understood the amount of innovation going on. They've understood how impactful that's going to be for productivity. And there's been a ton of money that has gone there. So it's become a bit of a crowded trade. However, it still has upside. And I think more generally, we've had 2 years of returns of over 20% for the S&P. I think we have to be realistic that it's not often that you get 3 years of over 20%. I think the prospects are still good, but we shouldn't be hostage to 2 exceptional years.
Mohamed, I also want to ask a little more about the U.S. dollar. Because obviously, as you mentioned, currencies have been very reactive to the headlines about tariffs. And sort of underlying that, or in the background, is this debate about, is a strong dollar better or worse for the U.S.? I guess I would ask you, what does strong dollar mean? What is the magic level for where the dollar should be, that it sort of balances the pros and the cons?
So you know that at some point, the dollar can be too strong, because you start getting the implication. First, it erodes domestic competitiveness. And because of that, it becomes a political issue. Second, strong dollars tend to break things elsewhere, particularly in emerging markets, who have borrowed in dollars but generate income in local currency. So they have what's called the original sin. And the stronger the dollar gets, the more they have to generate, and the harder they find it to generate. And the list goes on. So what we'd like to have is a stable dollar, but getting there means that other countries have to get their act together. If Europe continues to lag, if China continues to lag, then the pressure will be on the dollar to get stronger. So ultimately, the key issue is going to be for China and Europe to do the sorts of reforms that they need in order to grow at a faster rate, and then take off the pressure, which is pushing the dollar stronger.
Mohamed, how do you see market sentiment evolving then, given the risk and maybe the likelihood then of that stronger dollar?
It's ultimately going to be a race between the realities of what President Trump inherits and the extent to which certain policies could make things more complicated. For example, tariffs will push the dollar stronger. Against, on the other side, something that the markets have embraced for good reason, which is his deregulation and liberalization approach. So it's going to be a race to see which of the two sides. The market right now are betting on the deregulation and liberalization horse. They think that this horse will outpace the others, and we will see how that plays out.
And Mohamed, finally, just quickly, given all that we've been talking about, on balance, is this presidency of Donald Trump a greater risk or benefit to the market and to the economy?
It is seen as a greater benefit because it is seen as unleashing business and unleashing U.S. business. So I buy that. I understand why the markets are so enthusiastic, but we shouldn't underestimate that he inherits some pretty difficult issues. We talked about internal and external diversion. We haven't even talked about geopolitics and the extent to which that really hasn't impacted markets, hasn't impacted the economy because of the strength of the U.S. economy. But geopolitics are out there. So he inherits challenges, but the market clearly is betting on him unleashing U.S. business in a way that not only will secure a better outcome for the U.S., but will attract capital and have sort of a leverage effect in terms of benefits.
Mohamed, thanks so much for taking the time here with us before the opening bell this morning. We really appreciate it. And thank you, Julie Hyman, host of Market Domination, for joining us this morning as well.